Hello, everyone. I hope everyone's had a good week and is having a good weekend. So, the audio might not be the greatest here because I'm at the library, but it doesn't matter. Uh, this week I had CPI, which is a very high impact news, and we also had PPI, and I want to talk about the PPI release. So, we had negative 0.1% PPI, which is good, and then it's better than having it higher because PPI reflects the prices at which producers are paying for their products that they produce. The resources and the services which they buy to produce products for the consumers. Uh, that percentage is increasing, as you can see. They forecasted it to 2%, 0.2%, and it went all the way up to 0.5%, which is a big jump from negative 0.1%. So when PPI rises, oftentimes it's a leading indicator to CPI, showing that, okay, CPI may actually rise. And we have the core PPI, so if you look at the core CPI, it did go down, but PPI is going up, so it's usually leading. So the next CPI reports, we can potentially start to expect some higher CPI unless the PPI starts to correct. All right, that's just something I wanted to point out is that yeah, we're seeing a little bit of a slowdown in the decreasing CPI, and I think that it's just going to go back up. It's possible, very possible, it just goes back up to, um, and with GDP that we got last week, I do think we're we're not in for a lower CPI just yet at 2%. But anyways, let's get into the week. All right, so I said I would like to see the momentum on Friday continue, right? So first thing I wanted to do, week starts, I wanted this Friday momentum to continue if we were going to go to lower, right? That mean threshold, I didn't want to go back above it if we were going to go lower, back down to the fair value gaps down here. Um, and I did note how gold was rising again, so seeing higher prices was not out of the question. That's why I've written on the dollar. You see, we kind of closed at this order block, and this is kind of like, okay, we're closing all the way through this. That 50% should be resistance. If we do want the dollar to continue going higher and the stocks market to continue going lower, we really need to see Monday be explosive, and we can't spend much time. So the dollar, I wanted to see something like this and just immediately run to buy side liquidity. Um, and then I also wanted to see if it would do that ahead of the news. And this was in the hope for market to trade lower and complete a May seasonal tendency. Right, so this is if now that obviously we didn't get that, which I'll show throughout the week. Um, this is showing that we are very bearish on the dollar, even though we're in a seasonal tendency to be bullish and bearish on assets, right? So what that tells you is that there's a lot of buying pressure, so I wouldn't really expect a bearish summer. It's possible that we just stay bullish or just volatile in both directions, um, because it's an election year too. Then I was also looking at SMT between the bonds and the stock market as potentially, you see the bonds look a lot weaker, but the stock market's a lot stronger, and so I was wondering if maybe there's a correlation there, and we could start to see a retracement on the bonds, which would be a lot more bearish in the stock market, right? So I didn't look at how the bonds closed this week, but I will do that tomorrow. So yeah, coming into Monday, right? Friday's high was not traded to today. Price mostly consolidated, and then I said so far there's nothing I can trust in terms of direction. Okay, you see how we stayed inside Friday's range. So one thing I knew is that there was buy side liquidity at Friday's high and low, and that either of these points would be very sensitive. The Dow was showing bearishness. You see how much lower the Dow was, actually trading to the high and low of Friday. Alright, and this is a problem if I want to see lower prices, because I always say that the Nasdaq is the leading indice. If we're in a bear market, the true bear market, the Nasdaq should be leading lower. If we're in a bull market, the Nasdaq should be leading higher. So the fact that the Dow is lagging, or sorry, the going lower is telling me that it's lagging and it's not leading to the lower, because we're not in a bear market. So it's going to eventually be pulled up by the Nasdaq going higher. Okay, and the 4-hour chart just looked really ugly. I just wanted to point it out. Monday was really not a good day to trade, and I had to written it down as a do not trade day, on my journal, because I anticipated Monday to not be very nice day to trade. Alright, so this is the opening, should be right around, so Asia made a run higher, London ran up into this rejection block, and then 9:30 open, dumped down lower to come back into this bullish fair value gap beneath the midnight open. And the bodies also, look at where they're staying up above midnight open. They're not really wanting to go down here. It's just the wicks that are quickly wicking down there, right? So it's telling you that we are bullish here. As soon as we go beneath midnight open, we're seeing a lot of rejection higher. This is building up liquidity, and when I see wicks like this, a lot of people are buying. They probably think that there's a big support level. So I like to see price clear out all of these wicks eventually to really get people to think that, hey, this is no longer support. Whoever was buying here, stop buying, and prices are gonna fall. That's when I'm buying. So I also was looking at a regular trading hours gap, right, from the regular trading hours, which is just the stock market open and close. So we closed on Friday and we opened up all the way up here, and this is just a simple rundown to fill this gap. Since I didn't expect much on today, right, if you look at it, we really just moved sideways from the 15-minute chart. This looks very ugly. Right? We literally just moved sideways, and the best price action was just the 9:30 open, which was the only real news. If you consider 9:30 opening as news, which is something that introduces volatility, that was the best time to trade, just to go down and fill in this gap and then create a dealing range, which we consolidated within. Right, so the dealing range is a range that takes the high and the low of a range. So we came up, took out the high. Now notice how we take out the high, right? This is interesting because we leave a short-term high. Before this big dump lower, we leave one up close candle which closes above this high, right? And it's real nice and explosive above the short-term high. And we get another candle which is just as even more explosive in the other direction, leaving behind this as an order block. Okay, and you think of it on a daily chart too. If it's easier, like on a daily or weekly chart, if you see this candle close above a short-term high like this, a lot of traders are probably going to think that the way it closed is an engulfing candle, but they don't realize that they're far up into a premium, and so this is a very good condition to use this as an order block, right? If we created this instance in a discount, it wouldn't have been the same. Okay, and this is the 9:30 open. You could have used the order block up here. There's a nice fair value gap that we traded to. I was talking about this as it was going on in Monday's tape reading session. I just did a recording for tape reading because I wasn't planning on trading at all. And so, hold on. So now we're at Tuesday. Tuesday I did another recording on this. I did run into a loss here, and I talked about it. I wasn't able to record it because I was out of the house, but today was a bullish day on Tuesday. As you see, the PPI had came out, took out Friday's low, and then we ran up to Friday's high, right? So my mistake was, and you'll see this, but I saw the Friday's low be taken, and I wanted to see the high over here from Friday. Sorry, that candle. This is Monday. And as soon as we got Friday's high and Monday's high, I wanted the price to come back down into its range, because I just wanted to trade. So I tried to look for sells when I shouldn't have. So I noted that. And this is the range that was left on Friday, and then Monday moved sideways. We had a run lower at 8:30, sweep all that sell side liquidity, and it ran into an old new week opening gap from April, in mid-April. And we saw a quick movement higher, and this is where we got the buy side liquidity inside this candle. I was looking for sells to retrace back deeper discount in this wick, preferably. So instead it just continued going higher, right? That's okay. I noticed afterwards the order block here. This is an order block, and you have another order block there. You can couple that, and you have the midpoint. That's really what supports price very well. And even though all of this is above the midnight open, so today there wouldn't really have been an entry for me to go long because everything is above the midnight open. And I mentioned here, even though we hit buy side liquidity, right, prices still retrace and then continue to run higher. Note that both sides of the market were taken here. There was no reason to go lower. So I was just looking to trade just to go lower, right? Just for the sake of seeing a short for lower prices. There was also huge bearish divergence. Dow, the bodies, right, not the wicks, but the bodies making a lower low. This is a big, right? So this is obviously showing you that, okay, the Nasdaq is really leading, wanting to go higher, and prices were consolidating right ahead of the. You see how this consolidation sideways. We had a run down to this low that was created in order block, which started during the 1150 to 1250 macro, 1150 to 1210 macro, and that's what I was looking to trade. The trade that I took, you can go back and watch the video, but actually, I'll just show you here. So I talked about this. This is on the Apex account. We closed beneath this fair value gap. I wanted to shorten the 30-second chart up here, which I would have had a win if I had done that, but it was too quick. It entered the gap in like 1 or 2 seconds. It left. I wasn't able to press market sell, and they continued to run lower down into this low here at the midpoint of the order block, and I was 2 ticks away from take profit. So I'm glad this didn't work out though. What I should have happened was I should have put my stop at break even. But I talk about all that. I didn't follow my rules with the break even stop, and I took a full loss. But that break even stop would have protected me. And I'm glad that it didn't work, because it teaches me that, hey, don't look for these plays. Today you should have known that, okay, it's not a day to trade. After Powell spoke, after all this shenanigans happened, it was done. The draw happened, it occurred, and there was no reason. So there's no reason to keep looking for trades. But this is what actually happened in Market Maker buy model, and it was a really nice one too, with the buy side liquidity from the morning here and getting hit. And this was a complete different trading idea within itself. Not really my model, because I'm not really utilizing the midnight open and the day's manipulation and stuff with the 9:30 open, or the London sessions. This is just a market maker buy model that occurred in a day that you should have been done trading. So this is obviously showing you it's very volatile. Price has a lot of willingness to go somewhere. this is also the trade ICT took, and I really liked the trade he took because I mean, I'll just talk about why I liked it. But I initially, prices dumped lower. It traded to the sell side liquidity as I showed on the pictures before, and then we expanded higher. And on the 15-second chart, note all these gaps. We don't have a single breakaway gap like here, like this one, right? Or like this one over here, that gap. The area in price that is left unpainted by wicks. We don't leave a single one of those open, right? Like this one up here, we trade back into it. All right, and then the same thing with that one. We trade back into that. We consolidate around it, and I believe he started to build up his long position inside this fair value gap. All right, because he noted that there was no reason to go back lower, no reason to trade lower. And as price is crossing above the midnight open is now where it should really expand. It leaves another fair value gap, and this is where you want to start to see breakaway gaps. Right? If price fills this completely, it's just not as bullish, and then that's why it helps you determine how long you want to hold things for. Retraces back to the midnight open, and I really like this price action because it just stops the midnight open and it goes higher. It does that very often, leaving more breakaway gaps, right, that don't get filled. Then trading above the 830, swing lower, is I believe around where he took profits. And then Wednesday was a really nice day with CPI. So perfectly predictable price action. Yeah, a lot of times CPI is you don't really know. It's even if you know what CPI is going to do, you have a good idea. It's best not to trade off of it because if you're wrong, you can be very wrong and you can lose more money than you actually have in your account. So because the price can just teleport from one place to the next, and just simply there's nothing that will be able to stop you out at a place where you are still in a net positive balance. But big expansion towards the buy side liquidity. I talked about it Tuesday how I'll be wanting to see this is 18337.75. That's the mean threshold of the order block. I didn't want price to go back beneath that level. But also SMT. This wasn't as important. SMT isn't as important to me. It's just it helps to qualify trades to make sure you're trading the right index. So Nasdaq failing to make the lower low while the other indices do, right? Nasdaq showing that it's the leading one for the upside. You have a lot of consolidation ahead of CPI, right? Anyone that tried to trade in this is crazy. But London made the low of the day at around 3 a.m. or after 3 a.m. made a run lower to make that low of the day, and then we retraced back down near that low to maybe stop out early longs or scare people into shorts or out of their longs and then turning into shorts or just getting people short. Really, this move lower is what, and then we were traced back into these candles, and I was actually buying on a paper account, not my Apex account. So I say this is something I could have taken right here with that fair value gap. We see that price runs back down after trading beneath these lows into this bullish fair value gap and leaving low resistance liquidity, which it cleans up very nicely. It moved 100 points and it moved like 60 points in like 5 or 10 seconds. So it is not something that you want to be trading, because if I was wrong there and it went 60 points the other direction and I have a stop loss of 15 points, yeah, my stop loss isn't going to get respected. I'm going to be out at 60 points or wherever, maybe 40 points, wherever the market, because see how it just teleported, right? Price went from opening at here all the way to opening probably up here, right? And then it continued going higher. So you don't want to trade those things, even though if you have a good idea of what's going to happen. Anyways, after CPI came out, you probably had a lot of people that were looking to fill in this CPI range, the big candle that during 8:30 that expanded higher. Maybe there's a 50, yeah, okay, here. So you probably wanted to see, a lot of people probably wanted to see CPI run back down and fill in this gap, or seek more of a discount. But if you measure 50% of the range from this low of the gap to that high, it's about, and maybe it's on the hourly chart, so it's probably like here to like there. You get that level. We come down, touch it, consequent encroachment. I think it's this level here on the hourly, no, this 15-minute chart. I don't know why that one's different. Oh, that's the contract over contract. Okay, so morning consolidation ahead of the 9:30 open. 9:30 opens up, makes the run lower. The first 30 minutes, right? Usually, first 15 minutes, you're gonna see a run that opposes what most of the morning is gonna do. Sometimes it extends out a little bit until the first 30 minutes. So at 10 o'clock, we have an expansion higher after 9:30 traded lower beneath this low here, which entered a fair value gap. This fair value gap is here, the one in light blue. Look how bearish it is, how big it is to the downside. Price is clear, like people are clearly seeing this and being like, oh, well, this is going to be a continuation, silver bullet. We're going to continue going lower. No, there's buy side liquidity up here. There's daily, on the daily chart. There's buy side liquidity above, right? Where yesterday, look at where it closed. It closed way above, right? So it's normal to see price continue to expand, right, higher, just like it did yesterday. So you want to see a run on a discount, at a discount, right, on a low, on a discount low. So this is a 15-minute low. It's a high of a fair value gap, and we run down into that, and we once we close above this, simply just wait till it comes back in the range and then runs higher. Alright, I didn't look to trade on this because we were so far up into a range. I decided to just study it, and I didn't look to trade on that. But it wouldn't have been a bad time to look for trades for sure. And this fair value gap stayed open. Price came back into it, kept it open because it was refused. Notice how it refused to go back inside this balanced price range. It used this as a very strong support, and they used the order block as strong support, body staying out of it. So if we're refusing to trade back into this, you don't really want this fair value gap to be traded, through. Now, it can do that, but I would prefer it to stay open. So I should have said prefer to stay open. Buy side liquidity at 40 points and another at 60 points. Very easy, and low resistance liquidity. So very easy run up into that. Also market maker buy model. This also, once you do get up the buy side liquidity, this is also a run down into that 50%. You can project this range up, and you see it. What did it get to? 2 deviations. Now this happens very often. The 1, 50%, 2, 3, 1.5. All these levels can act as algorithmic support and resistance. And 75% usually never want price to really start to go back beneath that. So that's where this breakaway gap, you can anticipate it to be left open. And it can give you confidence once you get to that buy side liquidity, right? Instead of taking partials at 40 points and full close at 60 points, now it can give you confidence to hold your trades past that buy side liquidity if you're using that breakpoint model, which the breakpoint model, if I don't remember where I showed it, but I talked about it last week. It's my model that I made in August. But yeah, anyways, Thursday, I want to hurry up here because I gotta go. But Thursday, we were at high of the week, or all-time highs, and so a lot of people were thinking, all right, we're at all-time highs, it's gonna go lower now. We hit buy side liquidity. All right, look at how we've hit that during Asia session. Right, we came shy of it during CPI on Wednesday, and then Asia session expanded up on Thursday, and left buy side liquidity up here. In the morning, we get an initial run lower, right? Notice how we initially send price lower throughout the day. And this is where if you have a reversal day, right? Oftentimes a template is going to be London makes the high of the day, and then New York is going to come to take that high to make a new high of the day before going lower, and that's a reversal. So that's stopping out all the early sellers, all the people that woke up in the morning, saw price lower, saw buy side liquidity hit, and started looking for shorts. This is clear that price cleaned up all those early sellers, the early participants, the dumb money, and then price went lower. And what that does is it creates, they're not doing this, the algorithm's not doing this because it's mean. It's doing this because the bigger the money, the people moving the price, well, they need counterparty liquidity. They need people to counter their trades. So the algorithm's like living, breathing, just helping the markets move more efficiently, helping the big players, the big pockets to fill in their orders more easily, right? It's not to make money, it's just that they need their orders filled without affecting price very much. So they need as much counterparty as possible to offer money into the market so that they can, get filled. Very simple. So in the morning, I wanted this 1 hour fair value gap to be traded too, and I wanted the buy side liquidity to get hit. But I preferred to leave the buy side liquidity for after 9:30 open. So this was the 8:30 news release ahead of it. I got up early for it, the unemployment claims, and so I noticed a low resistance liquidity. Notice we have a high here, high there, lower high there, forming kind of a trend. And so when we initially were going lower ahead of this news, I said, okay, it would be very easy for price to come up and clean up all these highs, right? If people are shorting this trend, they're selling this trend, it'd be very easy for price to just run through that and then turn and go lower. This is the midnight open, by the way. A little bit off because it's at the high instead of the opening of the candle, but and then it runs lower down to the hourly fair value gap underneath the sell side liquidity. Okay, so that's exactly what happened. We ran up at the midnight open, a little bit off, but and then we ran down to the 1 hour, fair value gap. Right, so this was discontinued until when 9:30, which ran the buy side liquidity higher. Okay, and this happened throughout the whole morning. We ran higher. All right, but notice how 8:30 opened up, ran lower than 9:30. We already had the Judas swing 9:30. This time we didn't have that opposing move. We just opened up and continued going that direction because 8:30 had already offered the opposing move to the real bias for the morning, which was to go higher. So we had already people that were filled into shorts so that we could take it and run higher to the buy side liquidity above midnight open. Now this is one of the trades I took, the trade I took on that day from that fair value gap. But I was being nimble and I was noting the order blocks, the premium arrays. Why did I not want price to just go straight through it, and why did I anticipate that it could show some retracements, some deeper retracements, right? Because in 9:30 simply we had, if on the regular trading hours gap, price opens up and starts to shoot higher, a lot of people are buying. So to scare people out of their positions, or to get people short so that there's more liquidity, price will often retrace. Okay, this is the regular trading hours gap. This is what I showed on Monday. This here. So price opens up. See, if it just goes straight lower and it continues to go lower, it's too easy, right? Nobody is selling, everyone's just buying, so it's too easy. The market won't be efficient because they need people to sell to the people buying. So what it does is it's going to retrace, and this is what happened here. It retraced down. The S&P 500 made a lower low, the Dow made a lower low, but the Nasdaq leading only retraced down near the lows into this fair value gap, and there was a wick, 50% of this wick here, and it ran down into that. That's the level that I was watching before it ran down into it, and it came back to it here again. Bodies staying in a premium. Just a quick wick down there, right? Just to shake people out of their longs or to get the people short. If I was in this trade and I had held it all the way to that high, I would have gone stopped out. That's the purpose of this move lower, right? Because we had no opposing move after 9:30 open. right? But we still had that 8:30 news release that dropped us down. All right, and then the cool thing is, look at once we had this move lower, creating this huge bearish fair value gap. Price closes above, runs back down, and then trades higher. All right, I really like this trade, and I should have taken it, but I had already taken this trade on a paper account, on a different account, and I mean, I should have, but it's alright. This was a textbook trade, and I was there watching it. I don't have the recording because it was on a different monitor, so I captured the wrong monitor, and I could do a voiceover if I have. I don't think I'll really have enough time. I don't really think it's valuable enough. Just talking about it is okay here. So, anyways, inverse fair value gap. Draw that out. You see how we initially used that as resistance, then we get above it and we bounce between the 5-minute and that 1-minute fair value gap. Then we create this run lower, and this is where this move lower, you could project that same way as I projected the CPI move lower, because even though it didn't run the sell side necessarily like here at the very low, it still retraced into a discount array, and it's still a very fast and aggressive move lower that you can replicate on the upside. Right? You can replicate this move lower on the upside. This is all algorithmic. So this is 2 days in a row where I do something like you use the range lower to project it. Why wouldn't you use this range here? Because it's too big. This is not the same as a quick and violent move lower, and it's near the buy side liquidity, and we're expecting a reversal, not an expansion. So you wouldn't use the higher time frame move lower if you go on the higher time frame and use this range. That's not something you want to use because we're expecting a reversal. We're expecting price to get up here and turn quickly. But from down here in the lower time frame, you can expect lower time frame to use this to run towards that buy side liquidity. And then we have Friday. Nothing really exciting happened Friday. I did take a trade, which I showed. It was a pretty tough day, but simply where can I start? Yeah, so we had this order block, which on the hourly chart was created after trading 50% of that wick in a premium, and that ran out these early morning highs, leaving the low of the day, which was again traded to reverse on Thursday. We're just going to continue this momentum lower. So that order block, I was trading up to that order block, and fair value gap here. I didn't have it out of the question it could go higher than this high, and I wanted to see if it was willing to run to this buy side liquidity, and I had the one deviation there. But that was early in the morning, and notice how what do I say here? Initially, I wondered if this would be a breakpoint scenario. I very quickly did I see price was wanting to retrace inside the range. I missed that we were in a big premium. So yeah, so it's Friday. We're in a huge premium on Thursday. That momentum is just going to continue going lower. We're not going to go higher. But I wanted to see if 8:30 price would have stayed above this yellow range. If it would have continued to climb to that buy side liquidity, that could have been possible. But 9:30 retraced into that range. As you see here, it came back down at 9 o'clock near the low end at the rejection block. And then I wanted to see, price fool people into a short or long. And it did so here. So I got in to that 15-minute fair value gap so the price could seek a premium. And since we're not really expanding, we don't really want to see price leave any breakaway gaps. It's okay for it to come back and fill those right away. And that's what happened. After we filled in that, we had a nice run lower. This could have been another short, but notice the high resistance. Price having a lot of trouble getting down here. So overall, it would have been best to do my trading Thursday instead of Friday. But I'm still happy with what I was able to pull out for the week. And I hope that this was insightful to someone, or it will definitely be insightful to me in the future. And yeah, that's all.